The crypto market has seen an incredibly difficult 2022. Prices have been hit left, right and centre, the controversies of Terra Luna, Three Arrows Capital, and then of course most recently the meltdown of FTX have all contributed to the crypto winter. Among the industries suffering most directly from all of this though is Bitcoin miners. So what's going on with miners then? Well, a bit of background first. The Bitcoin mining difficulty, or the hash rate, we know changes roughly every 2 weeks. It correlates with changes in how much computing power is used for mining Bitcoin blocks. The more computers used for mining, the more difficult it becomes to mine. The hash rate has recently dropped, down 7.3%, its sharpest fall since 2021, when China banned crypto in July. What it shows is that more and more miners are turning their computers off. So why are they doing this? Well, Bitcoin, of course, reached an all-time high of more than $67,000 in November last year, but it has since fallen 75% to trade at below $17,000 at the end of 2022. That means miners are making 75% less right now from the Bitcoin that they're being rewarded with for mining. Adrian Wang is from MetAlpha, which is a digital wealth management firm based in Hong Kong. He told Forkast that a key issue was what happened last year, not what's been happening in 2022.
There's a headwind for miners, especially when last year Bitcoin hits a historical high, and a lot of miners expand kind of too fast, and they're taking leverage. They make the future orders to buy the mining machines. So they are kind of really not in a good situation right now.
Less valuable rewards are just one half of the story though. While the price of Bitcoin has dropped precipitously, the cost of mining has also soared.
The electricity cost is kind of very different globally. And after the Russian Ukraine war, and the electricity price went up a lot in US. I think the US miners is really suffering, but for some places like South America, like Southeast Asia, I know some of the miners are still doing okay. So it's really complex.
This is having an outsized effect on miners in the midst of the crypto winter. Let's take a look at one of the world's largest publicly listed miners, Core Scientific. Its third quarter earnings showed that its existing cash resources will, quote, be depleted by the end of 2022 or sooner. The company, which is listed on the Nasdaq, said its net loss for this year would be $1.7 billion, and that's compared to a loss of just over $13,000 last year. Other miners like Compute North and Argo Blockchain have either filed for bankruptcy or have warned about cash shortages. And a crunch on liquidity like this means that miners can't then invest, especially in more efficient machines, which could potentially bring costs further down. As projects started last year have come on stream in 2022, competition has been fierce.
The delivery time for the mining machines takes roughly a year. And you need to set up the facility, mining farms, and to get the machines running. It takes time. And because for last year's peak, when people place most of the orders, now they get the delivery, they get the machines now. And now these machines are just online.
This is why the hash rate has continued to soar this year, even as Bitcoin plummeted in price. And with more orders to come, the gap between mining difficulty and the value of Bitcoin is still expected to grow despite recent falls. This is having a knock-on effect throughout the crypto sector. Miners, of course, are defaulting on loans, and that's hurting crypto lenders. Those lenders are unable to make some of their money back because mining rigs used as collateral in the loans are also now worth less. Some, however, see this not as bad news, but as a potential opportunity.
I do see, of course, there are some consolidations in the space, and some I know some like so-called distressed mining asset funds are trying to acquire some facilities, some distressed assets. I mean, because it's cheap now. The mining machines cost is I think 1/4 or 1/5 compared to last year. And yeah, it's time to buy. I mean, for some people.
Miners too are adapting and in some cases are actually sounding optimistic. Here's Liam Wilson from Australian miner Mawson Infrastructure.
Miners looking for diversified revenue streams. Looking at hosting very closely, looking at their energy curtailment programs. Some miners are divesting assets, whether that be sites, containers, transformers, ASIC miners themselves, really looking to diversify their revenue stream.
For those miners that managed to survive the crypto winter, the future is also looking a little bit better, or at the very least it isn't looking worse.
When we look at our forward power through 2023, 2024, it looks a lot steadier. Now, we can't obviously control, nor do we have, a crystal ball into what's going to happen on a macro level, but certainly what this period did do was it put a real hyper focus on costs through our business, as well as diversifying our revenue stream. And so, we've really trimmed down our business. We're certainly not making money hand over fist like we were, but we can, we'll see it through, and, we just want to get ready for the next bull run.
Criticism, of course, remains about the impact that mining is having on the environment. Make sure you check out our previous episode on that for more details. Like the rest of crypto, miners are facing increased scrutiny from regulators. That includes new environmental rules currently proposed in the US. For some, however, the most important part of all of this is perspective.
If you look at from the past history, I think the most investors in the mining sectors is one of the group that makes the most, profit in the entire crypto world, because the miners are really long-term thinking. They hold the mine and hold the Bitcoins for years. That's how you make money in any sector, in finance.
It has been a momentous 12 months for the whole crypto sector, miners included, and we at Forkast have been trying our best to cover everything that's been going on. If you like any of the content, please hit that subscribe button and share it. It means a lot to us to be a part of these conversations, and we really want to hear your thoughts as well in the comments or on social media.